Section 10 of the Financial Crisis Inquiry Report by the Financial Crisis Inquiry Commission. This LibriVox recording is in the public domain. Chapter 3, Securitization and Derivatives. Part 3, The Growth of Derivatives, by far the most significant event in finance during the past decade. During the financial crisis, leverage and complexity became closely identified with one element of the story: derivatives. Derivatives are financial contracts whose prices are determined by, or derived from, the value of some underlying asset, rate, index, or event. They are not used for capital formation or investment, as are securities. Rather, they are instruments for hedging business risk, or for speculating on changes in prices, interest rates, and the like. Derivatives come in many forms. The most common are over-the-counter swaps and exchange-traded futures and options. They may be based on commodities, including agricultural products, metals, and energy products, interest rates, currency rates, stocks and indexes, and credit risk. They can even be tied to events such as hurricanes or announcements of government figures. Many financial and commercial firms use such derivatives. A firm may hedge its price risk by entering into a derivatives contract that offsets the effect of price movements. Losses suffered because of price movements can be recouped through gains on the derivatives contract. Institutional investors that are risk-averse sometimes use interest rate swaps to reduce the risk to their investment portfolios of inflation and rising interest rates by trading fixed interest payments for floating payments with risk-taking entities such as hedge funds. Hedge funds may use these swaps for the purpose of speculating in hopes of profiting on the rise or fall of a price or interest rate. The derivatives markets are organized as exchanges or as over-the-counter OTC markets, although some recent electronic trading facilities blur the distinctions. The oldest U.S. exchange is the Chicago Board of Trade, where futures and options are traded. Such exchanges are regulated by federal law and play a useful role in price discovery. That is, in revealing the market's view on prices of commodities or rates underlying futures and options. OTC derivatives are traded by large financial institutions, traditionally bank holding companies and investment banks, which act as derivatives dealers, buying and selling contracts with customers. Unlike the futures and options exchanges, the OTC market is neither centralized nor regulated. Nor is it transparent, and thus price discovery is limited. No matter the measurement, trading volume, dollar volume, risk exposure, derivatives represent a very significant sector of the U.S. financial system. The principal legislation governing these markets is the Commodity Exchange Act of 1936, which originally applied only to derivatives on domestic agricultural products. In 1974, Congress amended the Act to require that futures and options contracts on virtually all commodities, including financial instruments, be traded on a regulated exchange, and created a new federal independent agency, the Commodity Futures Trading Commission, or CFTC, to regulate and supervise the market. Outside of this regulated market, an over-the-counter market began to develop and grow rapidly in the 1980s. The large financial institutions acting as OTC derivatives dealers worried that the Commodity Exchange Act's requirement that trading occur on a regulated exchange might be applied to the products they were buying and selling. In 1993, the CFTC sought to address these concerns by exempting certain non-standardized OTC derivatives from that requirement, and from certain other provisions of the Commodity Exchange Act, except for prohibitions against fraud and manipulation. As the OTC market grew following the CFTC's exemption, a wave of significant losses and scandals hit the market. Among many examples, in 1994, Procter & Gamble, a leading consumer products company, reported a pre-tax loss of $157 million, the largest derivatives loss by a non-financial firm, stemming from OTC interest and foreign exchange rate derivatives sold to it by Bankers Trust. Procter & Gamble sued Bankers Trust for fraud. A suit settled when Bankers Trust forgave most of the money that Procter & Gamble owed it. That year, the CFTC and the Securities and Exchange Commission, SEC, fined Bankers Trust $10 million for misleading Gibson greeting cards on interest rate swaps, resulting in a mark-to-market loss of $23 million, larger than Gibson's prior year profits. In late 1994, Orange County, California, announced it had lost $1.5 billion speculating in OTC derivatives. The county filed for bankruptcy, the largest by a municipality in U.S. history. Its derivatives dealer, Merrill Lynch, paid $400 million to settle claims. In response, the U.S. General Accounting Office issued a report on financial derivatives that found dangers in the concentration of OTC derivatives activity among 15 major dealers, concluding that, quote, the sudden failure or abrupt withdrawal from trading of any one of these large dealers could cause liquidity problems in the markets and could also pose risks to the others, including federally insured banks and the financial system as a whole, unquote. While Congress then held hearings on the OTC derivatives market, the adoption of regulatory legislation failed amid intense lobbying by the OTC derivatives dealers and opposition by Fed Chairman Greenspan. In 1996, Japan's Sumitomo Corporation lost $2.6 billion on copper derivatives traded on a London exchange. The CFTC charged the company with using derivatives to manipulate copper prices, including using OTC derivatives contracts to disguise the speculation and to finance the scheme. Sumitomo settled for $150 million in penalties and restitution. The CFTC also charged Merrill Lynch with knowingly and intentionally aiding, abetting, and assisting the manipulation of copper prices. It settled for a fine of $15 million. Debate intensified in 1998. In May, the CFTC, under Chairperson Brooksley Born, said the agency would re-examine the way it regulated the OTC derivatives market, given the market's rapid evolution and the string of major losses since 1993. The CFTC requested comments. It got them. Some came from other regulators who took the unusual step of publicly criticizing the CFTC. On the day that the CFTC issued a concept release, Treasury Secretary Robert Rubin, Greenspan, and SEC Chairman Arthur Levitt issued a joint statement denouncing the CFTC's move. Quote, "We have grave concerns about this action and its possible consequences. We are very concerned about reports that the CFTC's action may increase the legal uncertainty concerning certain types of OTC derivatives," unquote. They proposed a moratorium on the CFTC's ability to regulate OTC derivatives. For months, Rubin, Greenspan, Levitt, and Deputy Treasury Secretary Lawrence Summers opposed the CFTC's efforts in testimony to Congress and in other public pronouncements. As Alan Greenspan said, quote, "Aside from safety and soundness regulation of derivatives dealers under the banking and securities laws, regulation of derivatives transactions that are privately negotiated by professionals is unnecessary," unquote. In September, the Federal Reserve Bank of New York orchestrated a $3.6 billion recapitalization of long-term capital management, LTCM, by 14 major OTC derivatives dealers. An enormous hedge fund, LTCM had amassed more than $1 trillion in notional amount of OTC derivatives and $125 billion of securities on $4.8 billion of capital without the knowledge of its major derivatives counterparts or federal regulators. Greenspan testified to Congress that in the New York Fed's judgment, LTCM's failure would potentially have had systemic effects. A default by LTCM, quote, would not only have a significant distorting impact on market prices, but also in the process could produce large losses, or worse, for a number of creditors and counterparties, and for other market participants who were not directly involved with LTCM, unquote. Nonetheless, just weeks later, in October 1998, Congress passed the requested moratorium. Greenspan continued to champion derivatives and advocate deregulation of the OTC market and the exchange-traded market. Quote, by far the most significant event in finance during the past decade has been the extraordinary development and expansion of financial derivatives, unquote, Greenspan said at a Futures Industry Association conference in March 1999. Quote, the fact that the OTC markets function quite effectively without the benefits of CFTC regulation provides a strong argument for development of a less burdensome regime for exchange-traded financial derivatives, unquote. The following year, after Bourne's resignation, the President's Working Group on Financial Markets, a committee of the heads of the Treasury, Federal Reserve, SEC, and Commodity Futures Trading Commission, charged with tracking the financial system, and chaired by then Treasury Secretary Larry Summers, essentially adopted Greenspan's view. The group issued a report urging Congress to deregulate OTC derivatives broadly and to reduce CFTC regulation of exchange-traded derivatives as well. In December 2000, in response, Congress passed and President Clinton signed the Commodity Futures Modernization Act of 2000, or CFMA, which in essence deregulated the OTC derivatives market and eliminated oversight by both the CFTC and the SEC. The law also preempted application of state laws on gaming and on bucket shops, illegal brokerage operations that otherwise could have made OTC derivatives transactions illegal. The SEC did retain anti-fraud authority over securities-based OTC derivatives, such as stock options. In addition, the regulatory powers of the CFTC relating to exchange-traded derivatives were weakened but not eliminated. The CFMA effectively shielded OTC derivatives from virtually all regulation or oversight. Subsequently, other laws enabled the expansion of the market. For example, under a 2005 amendment to the bankruptcy laws, derivatives counterparties were given the advantage over other creditors of being able to immediately terminate their contracts and seize collateral at the time of bankruptcy. The OTC derivatives market boomed. At year-end 2000, when the CFMA was passed, the notional amount of OTC derivatives outstanding globally was $95.2 trillion, and the gross market value was $3.2 trillion. In the 7.5 years from then until June 2008, when the market peaked, outstanding OTC derivatives increased more than sevenfold to a notional amount of $8.6 trillion. Their gross market value was $20.3 trillion. Greenspan testified to the FCIC that credit default swaps, a small part of the market when Congress discussed regulating derivatives in the 1990s, did create problems during the financial crisis. Rubin testified that when the CFMA passed, he was, quote, not opposed to the regulation of derivatives, unquote, and had personally agreed with Bourne's views, but that, quote, very strongly held views in the financial services industry in opposition to regulation, unquote, were insurmountable. Summers told the FCIC that while risks could not necessarily have been foreseen years ago, quote, by 2008, our regulatory framework with respect to derivatives was manifestly inadequate, and that the derivatives that proved to be by far the most serious, those associated with credit default swaps, increased 100-fold between 2000 and 2008, unquote. One reason for the rapid growth of the derivatives market was the capital requirements advantage that many financial institutions could obtain through hedging with derivatives. As discussed above, financial firms may use derivatives to hedge their risks. Such use of derivatives can lower a firm's value at risk as determined by computer models. In addition to gaining this advantage in risk management, such hedges can lower the amount of capital that banks are required to hold, thanks to a 1996 amendment to the regulatory regime known as the Basel International Capital Accord, or Basel I. Meeting in Basel, Switzerland in 1988, the world's central banks and bank supervisors adopted principles for banks' capital standards, and U.S. banking regulators made adjustments to implement them. Among the most important was the requirement that banks hold more capital against riskier assets. Fatefully, the Basel rules made capital requirements for mortgages and mortgage-backed securities looser than for all other assets related to corporate and consumer loans. Indeed, capital requirements for banks' holdings of Fannie's and Freddie's securities were less than for all other assets, except those explicitly backed by the U.S. government. These international capital standards accommodated the shift to increased leverage. In 1996, large banks sought more favorable capital treatment for their trading, and the Basel Committee on Banking Supervision adopted the Market Risk Amendment to Basel I. This provided that if banks hedged their credit or market risks using derivatives, they could hold less capital against their exposures from trading and other activities. OTC derivatives let derivatives traders, including the large banks and investment banks, increase their leverage. For example, entering into an equity swap that mimicked the returns of someone who owned the actual stock may have had some upfront costs, but the amount of collateral posted was much smaller than the upfront cost of purchasing the stock directly. Often, no collateral was required at all. Traders could use derivatives to receive the same gains or losses as if they had bought the actual security, and with only a fraction of a buyer's initial financial outlay. Warren Buffett, the chairman and chief executive officer of Berkshire Hathaway, Inc., testified to the FCIC about the unique characteristics of the derivatives market, saying, quote, they accentuated enormously, in my view, the leverage in the system, unquote. He went on to call derivatives very dangerous stuff, difficult for market participants, regulators, auditors, and investors to understand. Indeed, he concluded, I don't think I could manage a complex derivatives book. A key OTC derivative in the financial crisis was the credit default swap, or CDS, which offered the seller a little potential upside at the relatively small risk of a potentially large downside. The purchaser of a CDS transferred to the seller the default risk of an underlying debt. The debt security could be any bond or loan obligation. The CDS buyer made periodic payments to the seller during the life of the swap. In return, the seller offered protection against default or specified credit events, such as a partial default. If a credit event, such as a default, occurred, the CDS seller would typically pay the buyer the face value of the debt. Credit default swaps were often compared to insurance. The seller was described as insuring against a default in the underlying asset. However, while similar to insurance, CDS escaped regulation by state insurance supervisors because they were treated as deregulated OTC derivatives. This made CDS very different from insurance in at least two important respects. First, only a person with an insurable interest can obtain an insurance policy. A car owner can insure only the car she owns, not her neighbor's. But a CDS purchaser can use it to speculate on the default of a loan the purchaser does not own. These are often called naked credit default swaps and can inflate potential losses and corresponding gains on the default of a loan or institution. Before the CFMA was passed, there was uncertainty about whether or not state insurance regulators had authority over credit default swaps. In June 2000, in response to a letter from the law firm of Skadden Arps, Slate, Mayer, and Flom, LLP, the New York State Insurance Department determined that naked credit default swaps did not count as insurance and were therefore not subject to regulation. In addition, when an insurance company sells a policy, insurance regulators require that it put aside reserves in case of a loss. In the housing boom, CDS were sold by firms that failed to put up any reserves or initial collateral, or to hedge their exposure. In the run-up to the crisis, AIG, the largest U.S. insurance company, would accumulate a $1.5 trillion position in credit risk through the OTC market without being required to post $1 worth of initial collateral or making any other provision for loss. AIG was not alone. The value of the underlying assets for CDS outstanding worldwide grew from $6.4 trillion at the end of 2004 to a peak of $58.2 trillion at the end of 2007. A significant portion was apparently speculative or naked credit default swaps. Much of the risk of CDS and other derivatives was concentrated in a few of the very largest banks, investment banks, and others, such as AIG Financial Products, a unit of AIG, that dominated dealing in OTC derivatives. Among U.S. bank holding companies, 97% of the notional amount of OTC derivatives, millions of contracts, were traded by just 5 large institutions. In 2008, J.P. Morgan Chase, Citigroup, Bank of America, Wachovia, and HSBC, many of the same firms that would find themselves in trouble during the financial crisis. The country's 5 largest investment banks were also among the world's largest OTC derivatives dealers. While financial institutions surveyed by the FCIC said they do not track revenues and profits generated by their derivatives operations, some firms did provide estimates. For example, Goldman Sachs estimated that between 25% and 35% of its revenues from 2006 through 2009 were generated by derivatives, including 70% to 75% of the firm's commodities business, and half or more of its interest rate and currencies business. From May 2007 through November 2008, $133 billion, or 86%, of the $155 billion of trades made by Goldman's mortgage department were derivatives transactions. When the nation's biggest financial institutions were teetering on the edge of failure in 2008, everybody watched the derivatives markets. What were the institutions' holdings? Who were the counterparties? How would they fare? Market participants and regulators would find themselves straining to understand an unknown battlefield shaped by unseen exposures and interconnections as they fought to keep the financial system from collapsing. End of section 10 and of chapter 3.